Hello, good evening, good afternoon, good morning, depending on where you are at the moment in the world. Today we're going to be discussing about inflation. It's a very important topic at the moment. We are experiencing high inflation in many parts of the world, in Europe, in Asia, in US, in many other countries in the world. We are experiencing. It's important to understand what is inflation, what inflation rate we usually see in the economy, but why is it so high at the moment. To understand the reasons behind it, we'll see a lot of things. Actually, we'll also see a lot of data, actually. Data from the inflation in the last decade, in the last 12 months, and also in the last few decades or so, for various economy, US and European economies in particular, but also Asian economies. All right, we'll start with what is the current inflation rate in the world, especially in some of these most important economies. The average inflation rate as we speak in the world is 7.4%. That's actually much higher, actually, compared to what we normally experience in as the average inflation rate in the world. 7.4% is actually quite high, right? Well, this might actually change over time. This is the data from I think 3 months back. So it's 7.4%, which is quite high. So it was 4.35% in 2021, right? So it has almost doubled. So that's actually quite strange. And it used to be 3.18% in 2020. But 2020 was a very interesting year. It was a COVID year, the world shut down because of COVID. So maybe it was, not in a year, which is a bit different year. So we should not compare with the inflation rate of 2020. But 2021 was a better year compared to 2020, because we already had a vaccine, and economies were opening up. So it was a better year. And compared to last year, 2021, the inflation rate has increased manifold, almost doubled in the last couple of quarters. And Sudan is a country which is having the highest inflation rate at the moment in the world. But remember one thing, that countries like Sudan and Venezuela, they always have high inflation rate. So it is not a surprise that you see high inflation. So regardless of the period we are talking about, even in 2021 and 2020 and 2019 and so on, inflation rate was quite high in Venezuela and Sudan, in such countries. So it's not a surprise to see that the inflation rate at the moment in Sudan is the highest in the world, which is 260%. Right? So that high it is. Especially in some of these very disturbing countries in terms of economic stability, like Venezuela, Sudan, many of these African countries also, where you see high inflation. It is very peculiar, because it is mostly because of supply side constraints, lack of goods and services, because of which the cost of goods and services increase manifold in short period of time. So these are exceptions, but the inflation rate in European countries, US, Asian countries such as India, China, it is almost all time it is like at a moderate level, somewhere between 2% to 6%. Right? In some of the developing countries, emerging countries such as China and India, you expect a bit higher inflation, because these are high growth economies. So if a country is growing at a very fast rate, you expect the inflation rate to be a bit higher. So the inflation rate in India, for example, is almost always higher than the inflation rate in the US or the UK. Okay, because US and UK are mature economies. They are not growing as fast as India, for example, or China. But in India and China, you expect the inflation to be higher. So if there is a high growth, you expect inflation to be somewhat higher, but not like more than 10%. If it is like above 6% is considered a very high inflation rate. All right, and Venezuela is in the second place in the list of highest inflation. Well, Venezuela is always in the news for inflation, so it is not a surprise. We'll also see some data about the current inflation rate in various countries across the globe, in European countries, in the US and other places, and we'll see how it has changed over these years. So how do we calculate inflation rate? Simple formula is the change in the consumer price index in a given period of time. Okay, I'm not going to get into the details of how you select the period, how you calculate the CPI, but it is not, loosely speaking, it is about the change in the price level of general goods, right? When I say general goods, there are several goods in the basket. Oftentimes we only cite about food inflation, which is obviously very important, but food inflation actually fluctuates a lot. So food inflation is not the accurate way of knowing inflation. We need to include also other goods, because food prices fluctuate a lot. Agrarian products fluctuate a lot. We have to include other products as well in the bucket in order to understand inflation. Okay, so this is a simple formula. If you want to know more about it, Wikipedia is a good source actually, but there are also good YouTube videos on understanding the formula, inflation rate calculation formula. Okay, so here is the CPI inflation rate in the last few months in the US. As you can see, steadily increasing actually, right? Right, in January it was 7.5%. So it's the data for last 6 or 7 months until August. From 7.5% in January this year to 8.3% in July. In August it was 8.3%. So it's steadily increasing over time. And it is, I was reading in different news papers, Bloomberg and CNBC. They were saying that it could peak sometime in end of this year, sometime around November, December. But in the history, we have seen many times that the inflation remain very high for a longer period of time, not just for just 1 year, but it could also remain for 18 months or even 2 years. So it cannot be said for certain. It cannot be. There's no surety about it, but it is likely that it will pick up sometime end of this year or early next year. But depending on various scenarios, depending the war scenario in the Ukraine, crude prices, and so on and so forth. And we are not completely out of the pandemic yet, so that's also another question mark, how that's going to change, especially in the winter. All that will factor in. Nothing can be said for sure at the moment. All right, so this is for the last 1 year. So in the previous slide we just saw the inflation rate in the US for the last 6 months and how it is increasing. But you see for the last 1 year, the steep increase, right? It was somewhere around 5.5% a year back, but now it is 8.3%. It's almost 9% couple of months back. So that's a steep increase, like a massive increase in the inflation in just a year time. And what are the timelines? Remember, so the Ukraine war started sometime early this year, right? In January, February, around that time, and then the crude price issues started, right, because of Ukraine war, and then there were supply chain issues and so on and so forth. So yeah. So because of which you see an insane increase in the inflation, but it's not just the US actually. If we will go into the data of European Union also, the European countries and the UK, also the Asian countries, there also we see a massive increase in the inflation. There are some exceptions. For example, in China, we don't see an increase in the inflation at the moment. So China has been able to manage inflation quite well. For I don't know the reasons why, but US and European economies are struggling at the moment. UK is struggling big time. Inflation is actually probably, I think, highest in the last 4 decades in the UK. Now this is the inflation rate in the US for the last century, last 100 years. I've got this graph, actually done from a website. Reliable source, by the way. So it's all the information that I've taken is from reliable sources. So we cannot question the data as such. So you see that the inflation rate at some point in the US used to be even 20%. It used to be as high as 20%. But those were the growth years for US, the US economy, especially during the First World War and then the Second World War, 20s, and then there was a recession for about a decade, Great Depression. But after that, there was the US economy literally grew leap and bound. So when the economy is growing, then you can expect higher inflation. But it has fluctuated a lot actually. But there have been also instances when the inflation rate was negative. That means there is a drop in the prices of goods and services, and that is quite remarkable actually. It happened in the US, by the way, right? In the I think some 70 years, during the 30s and 40s, it happened that the inflation rate for many years were actually negative, sometimes even negative 10%. Quite strange. And you have seen many instances where it is like about 15%. Here also it's 15% during 1945, I think, right after Second World War, 1945 onwards. And then you have high inflation rate in the 70s also. 70s were the interesting years for the US economy because there was high inflation rate and there was high unemployment rate as well. It doesn't happen normally. So you have high inflation rate, that means growth is quite high. When growth is happening, you don't expect your unemployment rate to be very high. But sometimes that could happen. And that did happen in 1970s in the US, where the inflation was also quite high. So was the unemployment rate. And it's called stagflation. It's a different type of inflation called stagflation, when you have a high inflation rate and high unemployment rate. Then it gradually decreased in the 80s and 90s. And in the 80s and 90s, it was below 10%. All the times, right? You see, for the 80s and 90s, it was below 10%. But now suddenly, after 2021, you see the inflation is almost touching 10% now. Probably after 1980, in the last 40 years, it's the highest in the US. I think last 39 years, it's the highest in the US. That's quite remarkable actually, because things change just in a year time. In 2021, inflation was barely 5.5%. You never expect the inflation to be 0%. That's also not good. There must be some inflation, because if there's no inflation, then the indication is that the economy is not growing. So you expect some inflation, but somewhere between 1 to 6%. For developed economies, somewhere around 3 to 4% or 5%. For emerging economies like India, China, you expect a good inflation to be 6 to 8%, in that range. There are also some timelines here, right? For example, here 1944, you have Second World War. 1971, inflation, and the President Nixon abandoned the Bretton Woods system. In 79, Paul Volcker, that time I think he was the chairman of the Federal Reserve, introduced the anti-inflationary measures as inflation surpassed 13. I think this anti-inflationary measure was something like having a price cap, for goods. So I think that's the one he introduced. But it didn't work, by the way. It didn't work. Then in 2021, the demand surge. In 2021, you see the demand surge, right? Because for a couple of years during the pandemic, there was no production. So you expect demand for services to be higher when when the lockdowns were over, when people wanted to go out, but productions had stopped for a couple of years. So there were not enough goods, enough food items, enough goods, enough material to be consumed. So consumer demand was higher, but there was a lot of also supply side constraint because of war and commodity price increase and also a lot of supply chain mess. All right, here some this is the information regarding some other countries which are under hyperinflation. That means which is uncontrollable inflation. Now this is happening in many countries in the world. Actually, it's not just in 2020. Actually, even in other years this used to happen. For example, in the Sudan, in Venezuela, Lebanon, Zimbabwe, Turkey, Suriname, Argentina, Ethiopia, Iran. Now these are countries where economy is very unstable, not just from inflation point of view, but even from other point of view. For example, for Iran and Turkey, there are sanctions. There are many sanctions on these countries. So, Syria, Zimbabwe, these are poor countries. Lebanon, poor country. So economy is very mismanaged in this country, and hence you see high inflation. So regardless of the time, you will almost always see high inflation rate in these countries. And when it is out of control, like above 20% or something, it's called hyperinflation. That means it's beyond your control then. Yeah, here is even the longer list where you see a very high inflation. But this is inflation in European countries where you see inflation being more than 10%. Now you don't expect inflation to be higher in European countries. You can expect in African countries, in some of these more less developed countries. But even in the European countries at the moment, Turkey is an exception. But even other countries, we see more than 10% of inflation. For example, in Russia, in Lithuania, in Ukraine. Okay, in Ukraine, Russia, you can expect because war is going on, so you can expect the prices to be higher. But even in countries like Romania and Poland and Greece, you see the inflation to be higher, like more than 10%. Yeah, so it is indeed. There's a question actually on the chat box that people normally view Sudan to always having high inflation, but actually it's not always true. Sorry, not Sudan, Venezuela. But sometimes you also expect other countries to have high inflation, such as now it is Sudan. Okay. Where were we? Yeah, so we were in the European countries were having high inflation. Turkey, very high inflation, especially the Eastern European countries where you see very high inflation, right? Russia, even Estonia, Bulgaria, Czech Republic, Romania. Yeah, but in the Western European countries, I think it's still high, but it's still under somewhat control. And we'll come to that. I think in the next slide we have the more Western European countries, in Netherlands, United Kingdom, Belgium, Spain, Germany. The inflation rate is more than 5% there also. These are developed countries, matured economies. You expect the inflation to be somewhere around 5% or even less than 5%. But inflation in Netherlands is 9%. So quite high actually, almost touching 10%. In Germany it is 7.4%. So even in the developed economies, almost all places it is quite high. In the United Kingdom it is 9%, which is very, very high. So interesting. Okay, but there are some countries where you see the inflation to be under control. It is some of the lowest in the world. And interestingly, South Sudan is a different country. I didn't know that, but it has inflation rate of negative 8%. So Sudan is having the highest interest rate, and South Sudan is the lowest in the world. And that's quite interesting actually. So what exactly is the difference between South Sudan and Sudan? That Sudan is having the highest inflation rate of 260%, whereas South Sudan is having a negative 8.5% of inflation rate. There are other countries also like Bolivia and Maldives, Afghanistan, Hong Kong, where you see the inflation rate to be very, very low. I can imagine in a country like Afghanistan the inflation rate to be low, because there is no growth happening there. But I think what is noteworthy, what is important to note here, is that countries like Malaysia, countries like Saudi Arabia, China, Hong Kong, these countries, Maldives, these countries have been able to control inflation, which is superb actually, especially China. China is growing at a very fast rate. I think it's only even during the pandemics actually it grew. There was no negative GDP growth there. And for the last many years now, last couple of decades already, China has been growing at over 7 to 8% a year, and inflation is expected to be a bit high, like about 9%, 10%, consistently in China. But it's quite the opposite right now there. It's 2%, which is amazing actually. So I think the world, the countries should learn from China as to what China did right, the other country did not do, and the lessons should be learned from China actually, not just how they managed the pandemic, how they grew despite the pandemic, but also how they actually managed to control inflation. All right. So this is the projected annual inflation in 2020. You can see the map here. You see that. So I think 50%, more than 50%. Russia, see in the Asian part, Russia is where you see a very high inflation. But there are also some African countries where you see the red traffic light, right? So very high inflation. But China, for example, here in Asia is blue, which is less than 5% inflation. So is Australia. And there are some South American countries, like 1 or 2 countries, some African countries also, which less than 5% inflation. So, in the US it is supposed to be around 5 to 10%. Maybe it might cross even 10%. You never know. But until now, it hasn't crossed 10%. It has reached to 9.1%, and in the last few months it has gone to 8.5%. One thing to remember, one thing to note here is that in inflation, you can't just measure inflation for a given month actually. You have to take a moving average or an average inflation for, let's say, 6 months. That's a clear picture. In fact, in Federal Reserve, when they report something, they also take an average of it, because that might fluctuate a bit So you need to take a moving average or just a simple average for at least couple of months, 3 months minimum, but it could also be 6 months. Only then you will get a clearer picture. Otherwise, the inflation rates actually keep on fluctuating over months. Sometimes, sometimes goes up, then it goes down. But to get a clear picture, you need to take an average of a couple of months. So why are we experiencing high inflation in the world at the moment? Not just in the US or the Europe, but almost in most major economy, with the exception of China and Hong Kong, Malaysia. I'm also not talking about the Sudan and Venezuela, where you have inflation all the time, high inflation all the time, hyperinflation all the time. I'm talking about more the economy like India or European economies, Eastern European, Western European, Canada, and then the US. So supply chain issues started actually from last year itself, when we came out of pandemic, and it got aggravated after the first quarter of this year, followed by the war, which resulted in high commodity prices, energy costs rised, and when energy cost was higher, it had an impact on the food prices as well. So the prices of the food items just went up quite drastically. Then bad weather also and other climatic conditions had also an impact. For instance, this year the temperature in the Europe was perhaps highest in many decades now. That has an adverse impact. So weather impact and climatic impact will always have an impact from now on, especially from the last couple of decades. We have seen that the impact of climate change is now being seen not just on normal life, but also on the economy, and we see here some direct impact on inflation as well. So these are some of the reasons why it happened, and there's some one of the website has actually put up a very nice graph on the reasons behind, and also the timelines, I guess. For example, here it say the energy prices. So energy prices increase, so that's one reason. Then you have housing also. You see real estate prices increasing. A lot of people are having a tough time actually renting places. They're moving to villages, small towns from the big towns. So that is also having an impact. A lot of things are changing. So, and it goes without saying, the Ukraine war actually has a massive impact on the economy. Now it's important. I was actually telling about how to interpret inflation, and I was going through this website, the Federal Reserve's website, where they were put up some points as to how to interpret inflation. Because sometimes when you read inflation on different news channels, on news websites, actually, many times they don't clarify these things very clearly. These are very academic definition of how to interpret inflation. So the first point they mention is that inflation numbers can vary from month to month. So it is important to take an average inflation over a longer period of time, at least 3 months, but it could be 6 months or 8 months. So you can't just say, inflation last month was 9%, so inflation at the moment is 9%. That's not true. If you take maybe 6 months average, it could be 7%. So that's a better picture. Then subcategories of inflation. So when you have inflation, it's not just you have inflation in food prices, inflation in other kind of commodities, and so on. So it's important to understand which part of the goods bucket is contributing towards the inflation. It may not be that the prices of everything is increasing. That is not always the case. At the moment, actually, it is true, because almost all prices are going up. Like food prices and all kinds of commodity prices are going up at the moment, but it is not always the case. The third point is that sometimes we quote the food price inflation as the general inflation. That's actually not true. So the overall consumer prices, which is the core inflation, is more important, because food price inflation could fluctuate. It's very volatile. So that's also third point to give. It's a noteworthy point. And many people will be interested to know how does inflation affect your stock market. Well, if you have invested money in stock market, I guess by now you already know what the impact is, and we have seen the impact of high inflation in the stock market all over the world, not just in the US or Europe, but across geographies, across economies. We have seen stock markets doing very badly in the last many months now, since the war started in Ukraine. To put it very in short, we can say that inflation has an adverse impact. Some inflation is fine, like zero inflation is not good, because that indicates that economies are not growing. But higher inflation, like inflation of 9% in the US, indicates that the cost of borrowing will be very high for many companies, because the interest rate will be high. That's a negative thing for the economy. So economy is not growing, so people will not put their money in the stock market in buying stocks. They will not do that. On the stock market, it is an adverse impact, right? And we are currently seeing that actually in the US and Europe. Apparently in India, it's not, the impact is not yet very, very significant, but we could see that also maybe in couple of quarters. But it's also a bit subjective. Sometimes what happens is that there may be inflation, high inflation, but economies are growing, and in that case, people will still believe in the stock market. So they might think that this is a temporary phenomenon, and that will go away in few months' time or few quarters' time. So people will still go ahead in investing money, in putting money in stocks. But that's not the case right now. Economies are contracting. GDP growth is negative in many countries. So this is not a time. This is not a this is more of a recession time, right? Although we are not technically in recession, right? A global recession. Maybe some countries are already, but most prominent major economies are not yet in a recession. But it's not a boom time either, right? And in such time, if there is high inflation, then there is a negative sentiment, right? But sometimes also you have high growth and high inflation, like what happened in China a couple of like a decade back. High inflation, high growth. People were still believing in the stock market and they were putting money there. But this is a different time. All right. So what's the relationship between inflation and unemployment rate? It's an academic topic actually. I remember studying it in university. There's a famous curve called Phillips curve. So I think if you have taken some courses on economics, you might have already studied what is a Phillips curve. So Phillips curves tells you about the relationship between inflation rate and unemployment rate. Very simple to understand. You can see the curve in front of you, where you see that there is an inverse relationship between inflation and unemployment rate. If there is high inflation, there is high inflation rate in an economy, you expect the unemployment rate to be low, and the vice versa. Okay, so that's Phillips curve, and the logic is also very simple. That if the inflation rate is high, it may be because of high growth. The economy is growing very fast, hence there is high inflation. And when the economy is growing very fast, you expect the unemployment rate to be low, because everybody is getting a job, so everybody has a job, so there's everybody is participating in the economy, So your unemployment rate is supposed to be low there, and the other way around also, right? If there is low inflation, so there is less growth in the economy, or the economy is not growing at all. In that scenario, you expect the unemployment to be quite high. So there's a trade-off actually. Okay, you want to control inflation, you will sacrifice employment rate, and it's also the opposite is also true. So that's Phillips curve. We have learned it, but there are exceptions also. There are times when you will experience high inflation and high unemployment rate. That has happened in the US in 1970s. We have seen that high inflation and high unemployment rate. That could also happen. It has happened in the world. It's called stagflation. Okay, it's a different kind of inflation where it's a double whammy to the economy, where you see pressure coming from inflation side as well as from unemployment side. Whether we will be having stagflation in 2023 is a question. Some economists are also thinking about it, and they've given the opinion that it could be the case also. In 2023, we'll have a stagflation, high unemployment and high inflation. We'll see the historical relationship. So here you see the inflation and unemployment rate in the US. And the data is taken from 1978 up until 2011. So about 40 years of data. You see that every time there is high inflation, the unemployment rate is somewhat lower, right? So there is a trade-off. So there is a gap, right? In most of, you see here, right? For most of the years, you see a gap between the red and the blue line. That means, if one is the higher, the other one is lower. However, in the 70s, you see, even 78 to 1982, there was high inflation. Like inflation was like above 10%, 12%, 14% in 1980. But the unemployment was also more than 8%. In fact, it was 11% in 1983, when inflation was 11%. And unemployment was 11.5%. So that's a typical case of stagflation. Okay, but otherwise it's mostly a trade-off. It hasn't been experienced a lot, except in 70s in the US. In the UK is also you see the difference here. There is a trade-off. There is a gap between inflation and unemployment rate, right? And in the UK, there has probably never. This is the data from 2000 to 2015. Okay, 15 years data, not a long enough data, but you don't see stagflation also in this graph. This for UK. So I don't know if there was stagflation in the economy. Maybe this is an important question. I will check that in the internet. Yeah, we have already discussed about stagflation a bit, but just for definition, stagflation refers to an economy characterized by high inflation, low economic growth, and high unemployment rates. So that's the worst possible situation for an economy, where you have high inflation, economic growth is bad, so is the unemployment rate. So it's a typical scenario where there's a lack of supply of goods. So supply is bad, so prices are very high, and then the consumers don't have money to spend because the economy is bad, right? So it's bad in both ways. That means lack of demand and lack of supply. So the problem is coming from both supply side as well as the demand side, right? Doesn't always happen though, but sometimes we could end up in such scenarios. I was reading an article, actually, it was, I think, Washington Post, where the Fed's chairman, actually, Jerome Powell, right, at the moment, he has this opinion that we could have a stagflation and recession in the near future. That this has come from the Fed chief himself. So not a joke at all, right? You can go through this article actually if you want to. But it's interesting that this could happen. So bad times are coming. That's but don't always believe in the economic forecast. Sometimes it could turn out to be wrong. So, but no one can actually predict things. Certainly not in economy, right? It's so difficult to predict things in an economy. But it's likely that we would be in a recession with high inflation as well as with high unemployment rate. Now, how to control inflation? That's a $1 million question, actually, right? It's there are some straightforward ways to control that, but you will have again adverse impact on the economy through different means. Okay, governments can control inflation through monetary policy, but monetary policies are formulated by the central banks, not by the government. So what the central banks like Federal Reserves and central banks in a given country can do is that it can increase the interest rate. So because there is an increase in interest rate, very few people will be able to get loan or would like to take loan because the interest rate is very high. So the supply of money will be lower. It will be lower, and because of which, money supply being lower now will have an impact on the inflation because the prices will cool down a bit. But inflation could also be coming from the supply side of the goods also, right? In that case, it is somewhat less effective, although effective, but somewhat. Then sometimes reducing money supply. For example, in the pandemics, actually governments were giving money, direct money, like cash transfer to the people, and because of people have money, they can spend money, and they're not working also. Many people are not working because they have left the job, they have no job, so they don't want to work because now they are getting money directly from the government. So that's the worst case situation actually. So factories are not getting people. There are vacancies, but they're not able to fill in the vacancies. At the same time, people are having enough money to buy things. So that is a typical scenario where prices could go up very high, and that's something happening. Sometimes government can have price caps. Like government can come up with a regulation as to this would be the highest price for a given product. It was the case, I think, in the Nixon's time in the US in 1970s or early 80s. It didn't work actually. There's a good article on internet, you can read about it. The price cap, it doesn't help. And I don't think many countries, many central banks use that anymore. So the preferred way is to raise the interest rate. That's the best way. There's a very good video on inflation and its impact on The Economist YouTube channel, and I'm going to watch that right now also. I'm going to so I'll go over to that video and we can watch together.
It's big news. Bankers judging that the only way they can try to pull down inflation is to carry on raising interest rates.
We're going to see rising rates.
It's coming.
Rising interest rates that will make the cost of borrowing.
So interest rate is thing.
It can send ripples across the whole economy. It can sink consumer confidence, result in fewer jobs and lower wages, and cause stock prices to fall.
If they go too far too fast, it can tip economies into
By the way,
recession.
this point is not always true. Like fewer jobs, it's not always true actually.
If they go too far too fast, it can tip economies into recession.
So, why do central banks raise interest rates? Let's start with the basics. If you borrow money, you'll have to pay back a little extra to make it worthwhile for the lender.
Well, I think we can make you this loan. You have a good reputation. We know you're reliable.
I'm glad you think so.
This is the interest rate.
So if you are taking out a loan, you want the interest rate to be as low as possible so you don't have to pay that much back.
On the flip side, if you want to save money, then a high interest rate means you can earn more on your savings.
Yeah.
See it as a reward for leaving money in your account.
That's also
The
bad
size
for the
of your
economy.
reward depends on the circumstances.
There's no single interest rate in the economy. You've got thousands of banks setting their own commercial rates. That's all influenced, though, by the interest rate that the central bank sets.
A central bank is like a bank for banks. Just like you and your savings account, banks also earn interest when they leave money with a central bank.
Commercial banks have these things called reserves. So that's a bit like their cash on hand. Commercial banks lend those excess reserves to each other at an interest rate, and they also can deposit their excess reserves at the central bank. And when they do that, they can earn an interest rate. Ordinary people can't access the interest rate on the excess reserves, but it still affects them.
And that's the idea. When central banks raise interest rates, they're trying to control inflation, how fast prices rise for everyone.
They were 129, now they're 139, and that's in the space of 4 weeks.
Central banks like the Fed or the Bank of England or the European Central Bank are all trying to hit an inflation target of 2%. Interest rates are a really powerful tool that they have to do that.
If inflation is seen as too high, that's when banks raise interest rates. The change spreads through the financial system and slows down the rate of inflation. Here's how. A rise in interest rates from a central bank means that a commercial bank will earn more on their reserves. They might make more from keeping their money in a central bank than lending it out. So if they do lend it out, they'll raise their interest rates to make it worth their while. How that affects consumers depends on the economy. Take mortgages. In places like Finland or Australia, lots of people have mortgages with variable interest rates.
If you've got a variable rate mortgage where the interest rate that you pay is linked to the central bank's interest rate, then higher interest rates mean that essentially immediately the higher rate will translate into less cash to spend on other things.
Yeah.
Less spare cash means households will spend less. And less spending means businesses will be warier of raising prices. This should lower inflation. In other countries, like America or Canada, a bigger share of mortgages are set at fixed rates. People with fixed rates are protected against the direct effects of an interest rate rise, but will still feel an indirect impact.
Higher interest rates mean that mortgages will become more expensive. If that is affecting all new buyers, then house prices will begin to fall. And that will make everyone who owns a home feel poorer, and therefore they might spend less. Lower spending will translate into lower inflation.
And it's not just consumers who will tighten the purse strings.
When interest rates rise, then businesses will find it more expensive to borrow and invest. That generally means less economic activity. It might mean fewer jobs are created.
Fewer jobs and lower wages could mean less money for households, and consumer confidence might suffer, which also means less spending.
People are grappling with a decline in real wages, meaning their money buys less.
When interest rates rise, that will tend to slow down spending, investment, and generally depress economic activity. Overall, that will make businesses more reluctant to raise their prices, and that will tend to pull back inflation.
It sounds straightforward, right? But the trick is judging how far to go. In 1981, the Federal Reserve, America's central bank, allowed interest rates to rise to a whopping 19%. The move curbed inflation, but it led to widespread economic pain.
I regret to say that we're in the worst economic mess since the Great Depression.
It is very difficult to get inflation under control without severely denting economic activity. In America, it's been over 70 years since they've managed to get inflation down from over 5% without causing a recession.
A little inflation is okay. It keeps the economy moving at a sensible speed. But inflation staying high for too long is a problem.
Yeah.
Higher prices means employees will need higher wages, pushing up costs for businesses. That could drive up prices further, potentially leading to an upward spiral of wages and prices.
Retail inflation in India has surged to 7.8%. The combination of tepid economic activity and high inflation poses serious challenges for Indian economy going forward.
Central bankers are really concerned about setting expectations of inflation. The idea is that if it can show that it is credible, that it will always act to get inflation back down to 2%, then maybe it won't have to, raise interest rates and then lower them in this kind of seesaw fashion.
Raising interest rates can slow an economy right down. The trouble is, the brake pedal has a delay. It can take as long as 2 years to see the full results from interest rate changes. Central banks know this, so when they set interest rates, they're actually trying to read the road ahead. But predicting the future isn't easy.
The problem is, it's difficult for the central bank to work out whether the inflation will fall back on its own.
And even when central banks do get it right, they might still cause a crash. It may be a blunt instrument, but raising interest rates is still central banks' main tool for taming inflation.
Central bankers would say that yes, raising interest rates can be painful. Slowing down the economy is not fun, but it's worth it. It's worth it to get low and steady inflation so that in the long run, you don't have to think about it.
All right. So the bottom line here is that there is no easy fix to inflation. Central banks will try to increase the interest rate to curb the inflation, but that will have impact, a very adverse impact on the general economy. So, and you can't control the inflation in a very short period of time. Even if the central banks increase that interest rate, it will take some time before the inflation goes down. So it could take about a year or sometimes even 2 years time. So there is no easy fix to inflation. So that's the bottom line. All right. Thank you guys who joined us. If you want to join us again, we will be back again tomorrow or day after tomorrow with another topic. Thank you. See you next time.